things can happen quickly in this world, especially if you get some strong proponents. And Bitcoin jumps back over $100,000, you're going to have a lot of people, who are actually suddenly in favor of it. So it's absolutely an interesting journey that we're going to be on here. And these are the massive tailwinds that people are just ignoring right now. They are not priced into into this asset. They're just not priced into it. And so for those people who have been kind of frustrated and bewildered and surprised by this latest move, well, Bitcoin always has drawdowns and consolidates before it has another, leg up.
The crypto market is coiled like a spring, and Bitcoin's march toward $100,000 could unleash a tidal wave of institutional and retail demand that few see coming. Right now, skeptics dominate the narrative, focusing on short-term pullbacks and regulatory uncertainty. But history shows Bitcoin thrives in chaos, using consolidation phases as launchpads for explosive rallies. The moment Bitcoin reclaims six figures, the psychology shifts. Skeptics turn advocates, sidelined capital floods in, and the digital gold narrative goes mainstream overnight. According to James Lavish, a seasoned crypto investor, these massive tailwinds aren't priced in yet. He points to Bitcoin's uncanny ability to convert doubters during parabolic moves, a pattern playing out in slow motion. While markets obsess over Fed decisions and ETF flows, the bigger story is brewing beneath the surface, a supply shock waiting to happen as halving effects meet institutional adoption. For frustrated investors weathering this volatility, patience remains the ultimate edge. Bitcoin's 80% drawdowns and multi-month consolidations have always preceded its most dramatic climbs. The question isn't if momentum returns, it's when. And when it does, the rally could rewrite financial playbooks faster than Wall Street can react. Let's watch clips from James Lavish's interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
A lot of people get hung up around the gold demonetization of gold and how Bitcoin is going to take over gold, and they don't really think about much more than just that. Maybe, how much they can get as a percentage of the risk assets of the world, and that's how it's been treated. And quite honestly, it's not wrong. It's how it's been. You can see that Bitcoin is, I like to call it the tip of the risk spear. A lot of people have heard me say that before, and it has. It just it's the first thing that moves when people want to either add or extract from their exposures to risk assets, meaning typically, like high flying technology stocks or just overall beta in the market. Bitcoin has a beta to that, right? So it really does move like a risk asset, and it has for a while. So what we were saying there is that if you've seen Jesse Meyer's Croesus chart of the global assets, right? The global investable assets. And it's funny because, I used to make that same exact chart and they're pretty similar, slightly different colors, but I talked to him. He's, I'll give you the chart here so you can put up on the screen right now so people can see it. But, basically, this chart basically shows that you've got these massive swaths of investable assets. And so if you look at it and you think about just gold and where that is right now and where Bitcoin is. So looking at that world, a universe of investable assets, you've got gold is about 618 trillion. It's closer to getting 18 and moving up towards 20 now, but you've got art, which is about 18 trillion, cars and collectibles. You've got your equities, which are your true risk assets. That's fluctuating around close to 105, 110 now. But real estate of 330 trillion, bonds of 300 trillion, and then you just got your cash money market accounts and whatnot of 120 trillion. So what am I talking about here? Well, you've been seeing a lot of different products come out that are looking to start incorporating Bitcoin as part of collateral for loans and things like that. And you may have heard Andrew Hones talk about the Bitbonds, and he made a presentation recently about Bitbonds, and I actually wrote about it in the Informationist. And it's basically having a portion of whatever Treasury capital the Treasury raises by issuing bonds. They take a portion of that and buy Bitcoin with it and augment the returns of the bonds for both the investor and the Treasury. So, but what I'm talking about here is that Bitcoin to this point has just been treated as a risk asset. But as we continue down this path of just reckless spending, and now we'll back up for a second, hit the pause button here, that we have the Doge Commission and Trump and Musk are out there cutting costs dramatically, and they've cut about $200 billion of costs annually so far. That's a lot. It's not enough. The problem is structurally, we don't make enough money to pay for just the outlandish spending that we have. But part of it is, Luke, that it's spending that we can't cut. It's things like interest on the debt, right? Which is over $1 trillion now. It's about $1.2 trillion. And then, Social Security, Medicare, Medicaid, and things like that. Those are liabilities that are signed into legislation. There's only so much you can cut out of that through administration. You're cutting the administrators and the fat. You're cutting out the Social Security checks to people who are 250 years old. But there's not enough in there to cut it back by $1 trillion. We're going to continue to run deficits. That's just reality. The only way that we are not going to run deficits is if we have inflation and significant inflation. I'm not talking about 3-4%. I'm talking about a period of 8, 10, 12%, or maybe even more, where you're literally inflating away that debt by allowing for that inflation to create nominal growth in GDP. Now, everybody talks about the AI revolution, right? And how that's going to be great for productivity. Sure, it's going to make people more productive, but it's also going to take away certain jobs. And so the question is, how deflationary is AI? And what kind of levers do the central bankers have to pull in order to continue this charade of expanding the money supply? Because if you have lower GDP and lower prices of goods, well, how do you get rid of all that debt that you've piled up that was at a GDP that was way higher, right? So they have to continue to expand the money supply. There really is no way around it. So this is a long way of saying that because of that, you're going to see eventually you're going to see the people who understand Bitcoin and understand it as a true store of value to start to take some of their capital they've allocated just to risk assets and some of the capital they've already started doing that, but eventually they're going to take some of that capital they've allocated to bonds and real estate that they're using those as store of value.
Forget gold, forget stocks. Bitcoin isn't just playing with the big boys, it's coming for the biggest markets. The $330 trillion real estate empire and the $300 trillion bond market. Right now, it's trading like a hyper-growth tech stock, but as governments drown in their own debt and reckless money printing, the sharp money's catching on. Bitcoin-backed loans, Bitbonds, and a mass exodus from collapsing fiat systems are coming. When the great reallocation hits, Bitcoin won't just dethrone gold, it'll blow up the entire financial system. Bitcoin's endgame is replacing real estate as the world's preferred collateral. No tenants, no maintenance, just instant liquidity. With BlackRock's ETF paving the way, institutions are waking up to Bitcoin's potential as pristine collateral. No tenants. It's already crushing JP Morgan and Berkshire in market cap, and now it's eyeing the $300 trillion bond market. The moment pensions and endowments shift even 5%, prepare for the floodgates to open. Let's watch more clips from the interview.
Eventually down the road, I think Bitcoin will offer safe services for borrowing against. But for now, they'll use Bitcoin rather than real estate because, and not all of it, I'm just saying portions of that allocation that is set aside just for store value, right? So people invest in real estate because real estate goes up as the money supply expands. We know that. But why would they choose Bitcoin over it? Because it's super liquid, super easy to transact in. There's no maintenance cost. There's no headache of dealing with tenants or oversight or anything like that. You just put it in Bitcoin, leave it and wait. You just invest it and walk away, you know? So that's really where I think that this world is headed in Bitcoin eventually. We're not there yet. It's going to take some time, and we're going to have to decouple from the risk assets for that to start happening. And we'll have to have a real broad understanding and adoption from institutional investors for that to start, in my opinion.
James, do you think with BlackRock recently adding Bitcoin into its model portfolio, do you think this is maybe the beginning of Bitcoin beginning to decouple from risk assets and be seen in a different light?
That's a good question. I think that that first step is people seeing it as kind of like, oh, they're adding it to model portfolios. It still kind of reinforces that digital gold narrative. But until when they start adding it to portfolios that are not just portfolios with alternative investments, when they start adding it to portfolios that have long-term store of value and, kind of that 60/40 portfolio mix that they may have, well, that starts to change the narrative in my mind. What it does do, though, Luke, is, and that's a really good point you bring up, is that it informs the investors, the managers, investment managers, RIAs, and other managers who are in charge of other people's money. It gives them the green light to start looking at Bitcoin as an allocation as well for themselves, because in two ways. Number one, they can just look at it and say, well, I use the BlackRock model portfolios for my investors, and that's how I allocate to different exposures. And so it's in there. And so I just give the breakdown and allocate that 1 to 3% in those portfolios, just like they say to. Another thing is they could just look at it and say, look, well, BlackRock's doing it. And BlackRock has this IBIT and big ETF, and you can see the holders of that ETF and of the Fidelity FBTC and Bitwises. You can see that the holders there, and you've got some institutions there now. So people are starting to catch on, and it's starting to get to the point where, Luke, you have to start doing research here. If you're an investor, if you're an investment manager and you haven't done any research on this and you've just been shutting it off and saying, no, 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 the Wall Street Journal or CNBC says it's bad, that it's just a Ponzi scheme, so I'm not going to look at it. Well, you're doing a disservice to your business and your investors. You're acting against your fiduciary duty. It's up to you to be curious and to look into these things. It's now it's now near a $2 trillion asset. It's been $2 trillion and it's come back a little bit. And and it has overtaken basically every single asset in the world, but eight of them. It's a top 10 asset in the entire world. And if I bring this up and you'll see break down this chart, Bitcoin's right now at number 9. It's right behind Saudi Aramco, which is the largest oil and gas, energy company in the world. And it's right behind silver, which it had crested once and it's come back. But what are the assets that are bigger than it? Gold at 20 trillion. Yeah, see, it's $20 trillion now. Apple at 3 trillion, Microsoft, Nvidia, Amazon, Alphabet, all at two trillion and change. And then you've got silver, Saudi Aramco, and Bitcoin. Bitcoin's bigger than Facebook. It's bigger than Berkshire Hathaway. I mean, no wonder you hear Warren Buffett. It sounds like he's got a thorn in his side on that. Maybe it's hurt his ego a little bit. It's bigger than Eli Lilly, Walmart, JP Morgan. It's bigger than JP Morgan. I mean, no wonder you hear Jamie Dimon frustrated about it. This is not going away. It's becoming an allocation for people. They just have to understand it better, and it will decouple. When that happens remains to be seen. But I think that there's two big things that have to happen. And one of them is for broad understanding institutionally, investors institutionally understanding it. And then that reallocation of those store of value assets into Bitcoin. And that's going to be, I think, the key.
The U.S. Treasury could soon turn to Bitcoin to tackle its $14 trillion debt refinancing challenge, according to VanEck's Matthew Siegel. His Bitbonds proposal, 10-year Treasury notes with 10% Bitcoin exposure, offers a radical solution. Even if BTC crashes to zero, the government still saves money versus current 4% bond rates. But if Bitcoin moons, investors and taxpayers split gains after a 4.5% yield cap. This mirrors James Lavish's vision of Bitcoin evolving beyond a speculative asset into institutional-grade collateral. The math is compelling. At just 1 to 2% coupons, Bitbonds would save billions annually, while giving bondholders inflation protection, a growing concern as the dollar's dominance wavers. Similar proposals from the Bitcoin Policy Institute suggest $700 billion in potential savings over a decade. With Trump's pro-crypto administration warming to such innovation, the stage is set for Bitcoin to transition from Wall Street curiosity to sovereign balance sheet tool. Yet risks remain. Bitcoin's volatility could spook traditional bond buyers, and adoption requires regulatory leaps. But as Lavish notes, when institutions truly grasp Bitcoin's role as pristine collateral, the floodgates open. Whether Bitbonds gain traction or not, one truth emerges. Bitcoin's march into mainstream finance is now inevitable, and America's debt crisis might just accelerate it. As we wrap up, if Bitcoin captures just 5% of gold's market cap, where does that put the price? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.